what we cover in the curriculum, the MBA curriculum in the 4th semester, is I provide you with a template to analyze any company. And I can actually show you that template right now if you want to. So if you go to my website, harounventures.com, and you type in EMS-4-2, all lowercase, you can download an Excel spreadsheet. And this spreadsheet has everything you need to look at whenever you want to analyze a company. I download it here, and I'll open it up quickly in Excel. And it's based on the cumulative experience that I've had teaching students how to invest in companies, and also based on my, look at me buying time trying to find the file. It's also based on my cumulative experience trying to invest in companies. So I'm going to go to my downloads here. And again, you guys can download it if you want to as well. Never easy to find my download folder. Here it is here. All right, great. Yeah, and so it's based on my experience working on Wall Street at Goldman Sachs, working in the hedge fund industry at Citadel, and then working in venture capital when I had my own venture capital firm, and I did an investment in Facebook before they went public. So you guys can check it out if you want to. Again, you go to my website, harounventures.com / all lowercase EMS-4-2. Now, in this dashboard here, you'll see there's 100 steps on how to analyze a company. And let me make it a little bit bigger to get so you guys can see it. Hold on one second. All right. And so on the top there, you'll see qualitative research steps. Okay. In the middle, you'll see quantitative research steps. And then down here is financial research steps. And so from a qualitative perspective, the most important thing to always look at is the management team. And Richard Branson, you can't get better than that. Hopefully he's very much involved in that, not his other companies. So after you're comfortable with the management team, then I recommend going through the rest of this spreadsheet. Now, I mentioned start with the management team always because when I used to work in venture capital, we used to say we'd always rather prefer investing in an A+ management team with a B business model instead of investing in an A+ business model with a B management team. And you always want to look at the management team first because what happens is execution is of a paramount importance. Ideas are commodities, but execution is not. And so it's a very good filter for you as well to decide whether or not to invest or to do more research. So once you pass that first step of are you happy with the management team, you can document it all here if you want to. Then you go through all the other steps here. Now, when it comes to these very forward-thinking companies, the likelihood of them having earnings in the near term is very, very low. And so what I humbly recommend you do is you build out a financial model where you value the company based on your earnings estimates in 5 or 10 years. And you can do it, Demian, with all the steps here as well, okay, including income statement, forecast, balance sheet, etc., deferred revenue, cash flow. I have a lot of steps here for you. Let me finish off this question with how to think about earnings. So there's two types of investors. There's a growth investor and there's a value investor. Now, value investors, they want earnings right now and they want to buy cheap stocks like Warren Buffett. But value investors don't want the company to grow that quickly because they want the company to take their excess cash and instead of investing too much in R&D or salespeople, what they do is they create a big dividend or they buy back shares, making the valuation of the company much more attractive. Now, growth investors, on the other hand, and I'm a growth investor myself, growth investors, what they like to do is they like to create a financial model and they don't want the company to be profitable or very profitable today. And the reason is because they want the company to reinvest in hiring salespeople, in opening overseas offices, and investing a ton in research and development. So why would you buy a company then that doesn't have a price earnings multiple, meaning earnings are actually negative? Well, you do it because if you value the company in your financial model and you come up with earnings in 5 or 10 years that are a very big number, then what you can do is you take the price today divided by the earnings in 5 or 10 years. And that's how I think a lot of the smart investors think when they invest in growth stocks. So as you build out your financial model, Demian, what I recommend doing is valuing the company, meaning coming up with a target price based on your earnings estimates in 5 or 10 years. And I'll give you a couple of examples. And for years, people thought I was crazy investing in Amazon because there was no earnings. And they would say to me, Chris, why would you invest in a company that's trading at 150 times earnings or no PE? And I would say to them, no, it's actually trading at 3 or 4 times earnings. That means 3 or 4 times my earnings estimate in 5 or 10 years. And you got to be very long-term focused when you invest in growth companies. Other metrics you want to look at closely from a finance perspective are deferred revenues. And that's on the balance sheet. And what that means is instead of just looking at earnings and revenue this quarter, next quarter, et cetera, if a company sells something to a customer and they actually don't deliver the product yet, they collect the cash, then they can't recognize that by law as revenue yet. So that goes on the balance sheet in the liabilities section under deferred revenue. And so when you analyze companies and you look at their results, and sometimes you'll notice this, you'll notice that a company reports earnings and they miss their revenue estimate, but the stock goes up. And sometimes that happens because deferred revenue, meaning revenue they're going to be able to recognize from the balance sheet in future quarters, went up a lot. So when you analyze revenue of a company, you always want to look at revenue plus the change in deferred revenue, meaning last quarter's deferred revenue to this quarter's, because that will tell you what the pipeline looks like. And so revenue plus the change in deferred revenue is called bookings. And you got to look at that closely. But the bottom line is start with the management team, go through all those steps I showed you as well, and we'll cover that in a lot more detail in the Gold and Platinum program, which you're in, of my MBA program, in about a month or so in the finance and accounting classes.